Once you finish that, you'll be prompted to select which types of accounts you want to open. You have to buy and sell stocks within these accounts. It's like a checking account. You have to put your money in a checking account. Similarly, you have to put your investments in these specific investing accounts. The thing is, each country has different accounts. Some are similar, some are unique to that country. My goal is to make investing less of a hassle and less overwhelming for you. So I'm going to do my best to push you in the right direction with regards to which account to open. However, since there are so many small details and exceptions for each account, I'm going to keep it more high level here so you don't get confused and overwhelmed. I'll start off talking about general items and commonalities between investing accounts, regardless of the country you're in, and then I'm going to cover the main accounts in Canada and the US and guide you on which one I think you should choose. Unfortunately, I can't cover every single country in the world, but I hope that the first half of the video will give you a good general understanding of the different types of investing accounts, which you can use as a foundation to do more research about specific accounts in your country. That's the only research you'll have to do. Afterwards, you can just come back to this guide and follow the rest of the steps easily. Usually, when you buy your stocks and hold onto it for a long time and then eventually sell it, since it's extra money you're earning, it's considered income, meaning that you will have to pay tax on it. You pay tax on everything, and the same thing applies to investment profits as well. This is how normal, or in other words, non-registered investing accounts work. The profit you pay tax on is called capital gains, and the amount of tax you pay on capital gains depends on the country you're in. Since in these non-registered investing accounts, you pay tax on the profit you make whenever you sell the stocks, there is no restrictions the government is placing on you within these accounts. It's very flexible. You can buy and sell as many stocks you want whenever you want. Also, I want to emphasize that you only pay tax when you sell a stock and make profit. If you just buy and hold it, you don't have to pay any taxes because you haven't made any money. If you recall from before, you only make money or lose money in the stock market when you sell a stock. In addition to these non-registered accounts, there are other special registered accounts. All these registered accounts provide special benefits to invest. Most of the time, the benefit is related to taxes, and we can think about it in three different categories. I'm just going to call them category A, B, C. That lettering is something I made up, so it can be easier for us to keep track of things. The first benefit that some of these accounts have, category A, is it can shield your profits from investing from any taxes. In other words, any income you earn from investments in these accounts is tax-free, so you don't have to pay taxes on it, which is amazing. The second benefit I want to talk about, category B, is the amount you invest in these accounts can be used as a tax deductible. For example, if you invest $10,000 into a specific registered account this year, when you do your taxes for this year, you can then deduct that $10,000 from your total taxable income amount. Say your taxable income was $60,000 this year from your normal job. Since you invested $10,000 in a specific registered account, you can deduct $10,000 from your total taxable income amount, making it $50,000 instead of $60,000 for this year. That doesn't mean you lose $10,000 in income. It just means that the government is allowing you to show them $10,000 less in income. With taxes, the more money you make, the more taxes you pay. The higher income you have, the higher your tax bracket, so the percentage amount you have to pay for taxes goes up as your income goes up. So if your taxable income goes down, like what you're showing to the government, then it's actually a good thing because your tax bracket or tax percentage goes down, which means you'll end up paying less taxes this year. In short, some registered accounts offer the benefit of being a tax deductible, meaning that you can use it to decrease a taxable income for a year, and that will help reduce the amount of taxes you pay that year. The last category I want to talk about, category C, is similar to a tax deductible, but instead of a tax deductible, it's a tax deferral. In tax deductible, we reduce the income we show the government each year to reduce the amount of taxes we pay for that year. But with deferral, you can do the same thing, but instead of deducting taxes, you're deferring it, meaning that you have to pay the taxes later. That's the only difference between category B, tax deductible, and category C, tax deferral. All it means is that you have to pay taxes the year you take your money out of that account. Let's go through a scenario so we can understand this a bit better. Say you're in your mid-30s and you're making $100,000 right now. You decide to invest 10% of your income to your tax-deferred account, which is $10,000. You do that for 5 years, and in 5 years, you have about $50,000 in this account, and at the same time, your salary increased to $120,000. One more thing is that since the stock market was overall up, you made 10K in profits in your investments. So in your investment account, you have 60K in total. Now say in that moment, which is 5 years down the line, you decide to take out all the money in the tax deferred account. Your income for that year will be the 120K salary you're making from your normal job, plus the 60K that you're taking out from your investment account. This means your income rises to 180K for that year. Higher income means you'll end up paying a lot more taxes, like your tax bracket, or in other words, the tax percentage will be higher, and that's not something we want to do. The benefit in a tax deferral comes in if you take your money out during a time that you're expecting to not make that much income. So that way you will pay less taxes. Let's revisit that scenario again. Let's say in that year that you took out the money, you were on maternity leave or like paternity leave, and your income was about 20K. If you took out the money then your total income was 20K salary plus the 60K from your investment account, which makes 80K. Your income for that year, 80K, is lower than your income 5 years ago, which was 100K. So that means you'll end up paying less taxes. The whole point of a tax deferral is to postpone paying taxes to an year where your income will be significantly lower to save money on taxes. That's why when people invest in their tax deferred account, they take out their money in their 60s when they're retired. They know that when they're retired, their income won't be as high, right? They'll be really low. They might not be making any income at all. So when you take out the money from your tax deferred account, your salary is lower, your income is lower, you have to pay less taxes, and this will help you save money on taxes. As you can tell, this benefit of a tax deferral is a bit more complicated. Like for you to benefit off of this account, you have to think about your income and your future income and stuff. And for most beginners like us, this isn't something we want to worry about right now. We want to keep things simple. So that's why whenever I talk about an account that uses this tax benefit, category C, tax deferral, they usually have the word retirement in their name. It's probably not going to be my choice of an account that we should open right now. Is it still a viable account? Yes, but if we want to start investing right now, the other accounts are way more simpler to understand and to start off with. These are the 3 most common benefits with a registered account. Most of the time, you only have one benefit, sometimes you have more, but since these accounts are special and give you extra benefits for investing, they also come with specific restrictions. Most of the time, the restriction is with regards to contribution room, which is how much money you can invest or contribute to these accounts. The contribution room is set by the government and is different for each account. So to reiterate, the restriction with these special accounts is that there's a limit to how much money you can invest in them. And this limit is called contribution room. The contribution room only cares about the money you put in. It doesn't care about whether the money ends up going up or down because of your investments. So this was pretty much the general overview of the commonalities between registered accounts regardless of the country you're in. Now, I'll give you my opinion on what account I would invest in if I was in your position for Canada and the US. If you hover over the video, you can go to the specific section that relates to your country and you can just watch that section. If you find that your country's not here, I apologize for that. My best recommendation would be to find a different video or website online explaining the different types of registered accounts in your country. And once you understand that, you can simply come back to this guide and everything will make sense. So in Canada, there are 3 main or common registered accounts people usually open: the FHSA, TFSA, and RRSP. FHSA, First Time Homebuyer Savings Account, is specifically designed to help Canadians buy their first home that will be used as a primary residence, not for renting it out. It is the only account in Canada that provides 2 of the tax benefits that I previously mentioned. The profit you earn through your investments in these accounts are tax-free, which is category A, and whatever deposit you make into these accounts can be used as a tax deductible, which is category B. As you can already tell, this is a really good account to invest in due to all the tax benefits. However, as I already mentioned, the purpose of this account is to help Canadians buy their first home that will be used as a primary residence, not for renting it out. You have to use that money in less than 15 years after opening the account to buy your first home. And these tax benefits only apply if you use that money when buying your first home. If you invest in an FHSA and take out the money without actually buying your first home, then all the money you take out will be regarded as income for the year you take out the money. If you take out 10K or 20K, that is a lot of extra income that you have to pay taxes on, and it doesn't really make sense to invest in an FHSA in that case. Another alternative for people who open an FHSA but don't end up buying a house is to transfer that money to their RRSP. RRSP is another type of registered investing account I'll talk about soon, but if I was in your position, what I would do is only open an FHSA if I'm planning to buy a house. If not, the tax benefits are not there and I would invest in other registered accounts instead. So to reiterate, my opinion is definitely open an FHSA if and only if in the future you are planning on buying your first home. So how much money can you invest in your FHSA? Well, after you open your FHSA, every year you get a contribution room of $8,000 added to your FHSA. And the total lifetime contribution limit is $40,000. An example of this would be contributing $8,000 a year into your FHSA for the next 5 years. You can also contribute less than $8,000 in a year. Say you only contribute $3,000 this year. The $5,000 of contribution room, I'll still have it and it will be carried over to next year. So next year, I would have $5,000 plus the additional $8,000 in contribution room, giving me a total contribution room for next year as $13,000. The only small restriction to this is that the utmost maximum contribution room for a year is $16,000. Like say in year 1, you contribute $1,000. Next year, you'll have the $7,000 remaining space plus $8,000, which is $15,000. Now say in year 2, you only contribute $1,000 again. You would think that you would have $15,000 minus $1,000, $14,000, which is the contribution you have left at the end of year 2, plus $8,000 additional contribution room for year 3. But actually, that's not the case. The absolute maximum you can contribute in a year is $16,000. Even though you mathematically have $22,000 in contribution room for year 3, the absolute maximum is $16,000, so it actually becomes $16,000 contribution room in year 3. The contribution room doesn't disappear, it just gets postponed. So to recap, FHSA is for buying your first home, so definitely open it if you plan to do that in the future. You have 2 tax benefits with FHSA. The investment earnings are tax-free, and the contributions you make can be used as tax deductions. That's really amazing. Lifetime contribution limit to the FHSA is $40,000. And you get $8,000 of contribution space unlocked each year after you open your FHSA. The most amazing part is that when it's time for you to buy your first home, you can take out that $40,000 of money you put in, plus any profits you earn from investing, completely tax-free. Now, regardless of if the FHSA is something you open or not, the TFSA, tax-free savings account, is something everyone should be using to invest. Even though these names says savings, they're meant and best used for investing purposes to allow your money to grow. The TFSA only provides one tax benefit. Any investment profit, also known as capital gains, you make in this TFSA, you don't have to pay taxes on it. So essentially, category A. Not as amazing as an FHSA, which provides 2 tax benefits, but it's still really good. Almost any Canadian who is 18 years or older can open a TFSA, and the only restriction with the TFSA is with regards to contribution room. As soon as you turn 18, you first get contribution room, and every year after that, you get more and more contribution room to invest in your TFSA. The amount of extra space you get every year is determined by the government, and you can find it online as you can see on the screen right here. In general, unused contribution room from previous years is carried forward as contribution room to the next year. Say you turn 18 in 2024, you have $7,000 in contribution room, but you only contributed $3,000, you would have $4,000 carrying over to next year. In 2025, you would have that $4,000 plus $7,000 in additional contribution room for a total of $11,000 in contribution room. Even if you never invested before, the contribution room has been secretly accumulating in the background. Say you're 21 right now, and let's base it off of the fact that's 2025 when I recorded this video. You would have turned 18 in 2022. So you would have a total of $26,500 of contribution room available to you since you never invested before. One big difference between TFSA and FHSA is that in the TFSA, you can take out money whenever. This is really amazing. But if you put money into the account and then take out that money in the same year, your contribution room doesn't get updated immediately. Let's say in 2024, you started with $7,000 in contribution room. You put $7,000 into the account in January, and in February, you decide to take out $1,000. This money you take out, you can't put in right away in 2024. You only get that contribution room back in 2025. In 2025, you will get the $1,000 contribution room due to you taking out money, plus an additional $7,000 of extra contribution room for 2025. One cool thing I want to mention is that if you were 18 or older in 2009, which is when the TFSA was introduced, your contribution room for 2025 will be $102,000. you would have all that contribution room from all these years saved up and ready for you to invest in. To recap contribution room, this is a formula that summarizes everything. Your next year's contribution room is extra contribution room allocated by the government for that year. So every year the government gives you extra contribution room, so that's what this is about. Plus contribution room you had to start out last year, so it's 2025 right now. So this would be the amount of contribution room you had at the start of 2024 minus contributions you made throughout last year. So I'm in 2025 right now. Any contributions I made in 2024, I would subtract that amount. Plus, then I would add back any money I took out of the TFSA last year. So any money I took out of the TFSA in 2024, I would add it back to get my total contribution room for 2025. I know this part could have been a bit complex to understand, but trust me, the way we're going to invest, I'm going to make it way easier for you. So even if you didn't understand every single thing, don't worry too much about it. That pretty much summarizes the TFSA. It's the investing account with least restrictions, and every Canadian should be investing in their TFSA for sure. The RRSP, Registered Retirement Savings Plan, is an account that is meant to help Canadians save for retirement. The tax benefit that the RRSP provides is a tax deferral, which is Category C. If you recall, this means that any investment into your RRSP is used to reduce your taxable income in the present, but you have to show that money when you take it out as income in the future and pay taxes on it in the future. Since it's a special account, it also has contribution limits that work very similar to the TFSA. Every year, you can contribute 18% of your earned income in the previous year, as long as this number is less than the annual limit for the year, which you can find on this website. Like if your income is so high that 18% of your income is higher than this number, then you unfortunately can only contribute this number. RRSP contribution room is very similar to the TFSA in a sense that it accumulates. In the TFSA, each year after 18, there is a contribution room being accumulated whether or not you open an account or invested. It pretty much never goes away. The same thing applies to the RRSP. In the RRSP, the contribution also doesn't go away and you can decide to use it whenever. It is hard to track this because your income can change every year, so that's why the government has created a tool called CRA My Account to help with this. One big difference between TFSA and RRSP is that if you take out money from RRSP, you never get that contribution room back. There is a bit more detail with RRSP, like some exceptions on withdrawing money tax-free and stuff, but I'm not going to go into it so I can keep this guide easy to understand. As I mentioned before, this type of account, like tax-deferred account, is something that I don't think it's best for beginners like us to start investing in right now because it takes a bit of work to plan our income and when we want to take out money strategically and stuff. So that's why I'll stay away from the RRSP for now. I think the other accounts are way easier and better to start with. The only exception to this will be if your employer offers RRSP matching, which means your employer will contribute as much as you contribute to the RRSP up to a specific amount. This is great because it's almost like your employer is giving you more free money, but not all employers do this. If you know your employer does do RRSP matching, then the RRSP is something I would recommend you do more research about. So let's summarize all the accounts and really focus on what you need to take away from this section. I know it's long, but the takeaway messages are pretty simple. If you're planning on buying a home, definitely think about the FHSA as it provides two tax benefits, tax-free and tax-deductible. Regardless of if you open an FHSA or not, the TFSA is something everyone should also definitely be investing in. Even though it doesn't give you as much tax benefits as an FHSA, the fact that it has no restrictions on withdrawing money means that you can access your money anytime, and that's very important. So based on this discussion, I hope that you can figure out which accounts you're going to open. You don't have to only open one, you can open multiple accounts. I personally opened a TFSA and an FHSA. Once you decided which accounts you want to open, you want to click the appropriate buttons in Wealthsimple to do that. Yes, I know it's been a while, so if your screen timed out or Wealthsimple automatically logged you out, just log back in, it should be fine. If you weren't prompted to open an account, or you want to open another type of account in the future, you can just click this button right here and choose which account you want to open. Once you follow all the steps and provide any necessary information and agree to all the documents, you should have investing accounts all set up. Make sure to choose self-directed investing if you're asked to choose between self-directed and managed portfolios, since you are going to be investing yourself. Last but not least, if you're asked anywhere if you want to transfer an account, that's for people who already have money invested at a different bank and they want to transfer their entire account to Wealthsimple. So I think for most of us, that wouldn't apply, so you don't have to worry about that. With that being said, that's it for this chapter. The rest of the video focuses on different countries, so you can just skip this video and go to the next video. So with the US, there are quite a few registered accounts that are all viable options depending on your situation. Most of these accounts are retirement accounts, so instead of going through every single one of them, because honestly it will take another hour to go through all these accounts in detail, I'm going to focus on one really good one that you can open right now. Then I'll briefly touch upon the other accounts that you can look at into later if you're interested. The Roth IRA is a retirement account with only one tax benefit. IRA stands for Individual Retirement Accounts. Any investment profit, also known as capital gains, you make in the Roth IRA, you don't have to pay taxes for. So this is a Category A tax benefit I previously mentioned. There are no other tax benefits like tax deductions or tax deferrals, so this is an easy account for everyone to understand. Almost any person who earns income and pays taxes in the US can open a Roth IRA, even if you're a teenager. With the Roth IRA, each year your contribution room resets. This means that if you don't use all the contribution room for that year, then that opportunity to invest is gone. Since it's so strict, the government has been a bit lenient and said that you have till the time you do your taxes to invest in this account. Like for 2025, you can obviously invest in 2025, but you also have some extra time in 2026 as you only typically do your 2025 taxes in April of next year, so 2026. Regardless of how much money you invest this year, next year you get a new opportunity and a new contribution room that you can use to invest. The amount of contribution room you get each year depends on your income and can be found on this website right here. This link gives you more detail and shows you how your contribution limit changes based on your income. You can think of the second column as your income. If your income is high, then the amount of contribution room in your Roth IRA decreases. These three rows have a higher amount because it looks at your combined income of you and your spouse if you're married. And the contribution room for each of your accounts would be as indicated in the third column. Since the Roth IRA is really a retirement account, there are some restrictions with regards to taking money out of your Roth IRA. Only the contributions you make to the Roth IRA can be withdrawn anytime. The capital gains or like investment growth or like profit, that can be only withdrawn after 59.5 years and after you invested in a Roth IRA for at least 5 years. If you do withdraw profits before that, you have to pay a penalty and that's losing money, so we don't want to do that. Obviously, with investing, the goal is to invest for super long term. But if your plan is to maybe retire at 45 years old, since you're working towards financial freedom or something, then just be aware that you can't take out the capital gains till 59 and a half. The actual money you invest can be taken out anytime. For example, you contribute $7,000 for 5 years, which is $35,000. This money grows to $40,000 through your investments. You can only take out the $35,000 anytime. That $5,000 investment growth, you have to wait till 59 and a half to take out, or else you have to pay a penalty. One more important thing is that if you take money out, you don't get the contribution room back. That contribution room pretty much disappears. There are many other investment accounts in the US as well. There's something called a traditional IRA, which is similar to a Roth IRA, but with a bit different tax benefits. There are also several types of 401ks, which are also retirement accounts. And another thing to note is that you typically do need an employer to open a 401k account because 401k plans are employer-sponsored retirement plans. This means that they're created and administered by your employer. I want you to start investing right now. That's why I talked about the Roth IRA, because it's an account that I would start investing in with right now if I was a beginner investor in the US. One thing to note is that many employers do provide a match to your 401k contributions, meaning that for every dollar you invest in the 401k, the employer will also make some sort of contribution to the 401k as well. And this will be extra money on top of the salary they're already paying you. Obviously, this is amazing because it is free money, and if your employer does provide that, I would recommend you spending some time researching the 401k options your employer provides and maximizing your contributions to that account. I encourage you to spend time researching these accounts in the future. It's more than enough for you to open a Roth IRA now. As I mentioned, I want you to get started with investing right now. If you find that the other investment accounts are not a good fit for you, I want to remind you that you also have the normal brokerage or like non-registered account as an option. Although you have to pay taxes on the money you earn, the money you earn will be more than the taxes you pay, so it will still be worth it. Once you follow all these steps and provide any necessary information and agree to all the documents, you should have your investing account set up. You can just go to the next video, which is the next chapter of this guide.